Good morning or good afternoon. It's slightly afternoon on Friday, the 21st of October here in New York. I'm Jeff Christian of CPM Group. I want to talk today about the energy transition and its likely effects on the platinum group metals market. CPM Group produced a market alert this week related to that, and I want to focus on that. However, there are certain topics that I want to talk about that we will be, I'll just briefly talk about them today and mention them. Hopefully we'll cover them in greater detail in coming videos. One is the coming recession, investors profiting with options, and the gold that is not moving from the west to the east. Those are three topics that are out there. As I say here, there is a recession coming. No one's quite sure when, or how deep or how long it'll be. Talk about that later. I'll cover these three topics in greater detail later. As I said, CPM Group issued an 11-page market alert on the issue of the energy transition and its effects on platinum group metals this week. It's available on our website for purchase, and clients who have consulting agreements can get it for free. The projections in it are from the International Energy Agency and from CPM Group, and they are contrary to some of the unrealistic expectations about the energy transition and future PGM uses in energy industries that you will see around. I heard a data point recently from the former head of the Canadian Manufacturers Association. There are not enough product engineers to design all of the components that would be needed in just the electric and hybrid vehicles whose models have been announced. So there are a lot of constraints to how fast we will make the energy transition. And the IEA has some very good information about that. What we've done with this market alert is we did a roadshow with institutional investors in South Africa. We do these twice a year. We did one in September. We worked with NOAA Capital Markets in doing this since 2004. We've done it since the 1980s, but since 2004, we've done it with NOAA Capital Markets, which was created in 2003. And part of the issue, these roadshows in South Africa to institutional investors, focus on gold and platinum group metals primarily. And part of the issue was just the issues related to the likely effects of the energy transition on PGMs. So we excerpted that and produced a market alert. And we're making that available to clients for free as part of their programs with us, and to others who want to buy it for $10. This is data from the International Energy Agency, and I've used this in previous presentations. The IEA projects that by 2040, we will be using more oil and more natural gas than we are today. And that oil and natural gas will be the two major sources of energy in 2040 for humankind. We'll still be using a lot of coal, as you can see, but the amount of coal they project will have declined. Other renewable sources of energy will be rising sharply, but they will still fall far short of the energy requirements needed in the world. Nuclear will rise very slowly. Bioenergy will rise slowly but steadily. And hydroelectric power will be relatively limited. And if you look at IEA projections at 2050, you can see in 2050 they still have petroleum as our major source of energy, natural gas as our second largest. Renewables will replace coal as the third largest after 2040. So that's the energy component. The basic message is we're not going to get rid of carbon dioxide and other greenhouse gases anytime soon. There are just too many constraints to that rapid of a movement. And even if you do have a very rapid growth in green technologies and green energy sources and renewables, it won't be fast enough to replace petroleum and natural gas, at least for the next 30 years. That's very important for platinum group metals and for a lot of other metals, because what it means, we're going to be burning petroleum products well into the second half of the century. And we're going to need platinum group metals to clean the exhaust from combusting petroleum-based products. Another topic that we cover in the market alert is the projected use of fuel cells. And in September, just as we were making this roadshow, a South African platinum producer gave a presentation and said, we're looking at 2.5 million ounces of platinum production, platinum demand by 2040 from green technologies. 1 million ounces in fuel cells and 500,000 to 700,000 ounces in what people outside of the United States call electrolysers. We call them electrolysis, making hydrogen out of water through electrolysis. And energy storage systems, another 700,000 ounces. Very rosy, optimistic portrayal of platinum use in green energy technologies that doesn't stand up to scrutiny. These are projections that have been made by the South African platinum mining industry and their marketing agents since 1980. Compare how much platinum would be used in fuel cells compared to CPM Group's estimates of how much was actually being used from 1988 through 2021, and our projections from 2022 through 2040. Those little black bars at the bottom are our estimates of actual platinum use and projections. And we have it, you can see, around 35,000 ounces a year right now, and by 2040, getting up to about 100,000. Meanwhile, and the big dates above the big bars represent the years in which the projections were made by the South African industry as to how much platinum would be used in fuel cells. So in 1980, they were saying that by 1988, 320,000 ounces would be used. In 2003, that red bar, they were saying that by 2010, we'd be using 500,000 ounces. And the big green bar over on the right is the quote this year of 1 million ounces by 2040. Always overly optimistic, and kind of in contrast to issues and information that comes from the fuel cell industry. Now, we do expect fuel cells vehicles to come alive, but you can see here from our projections to 2050 that we see the growth primarily after 2040. And these projections here only go out to 2040. But we do see that. Now, it's mostly off-road vehicles, vehicles at airports and other fleets where you can have a hydrogen manager, and intracity buses. And what we've seen so far are intracity buses, 94% of which I believe are in China right now, where you have a fleet manager and you have a managed economy that can put these things in on a demonstration basis right now, and they are going forward. So we don't see fuel cell vehicles as being particularly big sources of replacing petroleum, nor do we see them being big sources of platinum demand. But you don't have to take our analysis and projections. These are the international energies agencies, and the green bars at the top are fuel cells. This is the billions of dollars that are estimated to go into clean energy technologies between now and 2050. On the right-hand side are the NZE scenarios, which represent if everybody lived up to their pledges from the Paris Accord. That's overly optimistic. It hasn't happened in the last, I think it's 14 years now since the Paris Accords. The steps projection in the middle is what if everything that's been, all of the trends that have been in place for the last 10, 20 years continue for the next 30 years. And there you can barely see fuel cell investments in 2030, and you start to see it in 2050. So the IEA and CPM Group are in agreement. Fuel cells are not going to be too big of an energy technology, and it primarily will be off-road vehicles and intercity buses. The IEA has modest expectations for fuel cells and for electrolysis of hydrogen, both industries. These are their projections. Again, the yellow bars here are what they used to call the SDS, now they call it NZE. That's the optimistic zero carbon emissions by 2050 because everybody's living up to their pledges from the Paris Agreement. And the orange bars are the steps, or the more realistic one set of projections, which is what CPM Group uses. And you can see electrolyzers not really around by 2040. By 2050, they start to emerge. And in fuel cells, very little by 2040 and very little by 2050 in the steps scenario. The IEA sees auto catalysts as the major source for platinum demand in vehicles all the way out to 2040. We do too. That report's available. You can go to our website and download it at this site, at this point. It costs $10. You can contact us. Clients, as I said, that have consulting packages with us, they can get it as part of their consulting packages at no costs. We also are moving to post our reports more on Bloomberg once again. We were doing this a few years ago and it kind of fell into disuse. We're starting to resume that. So you can go to our Bloomberg page. If you're a Bloomberg subscriber, you can go to our Bloomberg page, which is NHCGR, and you can see some free reads, including the press release that we issued yesterday or the day before for the market alert. And you can also find, I believe, a report we did for Gold Bullion International on why it's unreasonable to think or worry about future gold confiscations in the United States. Kind of interesting read. It's available at Bloomberg's on our page as free reads. There are two sections of CPM Group's work on Bloomberg at this point. One is a free reads for anybody who has a Bloomberg terminal, and the other one is an entitled section where CPM Group clients can access reports that they've paid for. If you want to discuss options on receiving this and other reports and future reports, send us an email at info@cpmgroup.com. We used to publish a lot more market commentaries and market alerts. We kind of grew away from that because we have the trade recommendations and we have the twice weekly videos. But I think that we probably will be resuming that. And we also will be posting other reports that we produce for Gold Bullion International, as well as other clients on our Bloomberg page going into the future. We had produced a long-term report on platinum group metals, platinum, palladium, rhodium, supply, demand, and price to the year 2050. We updated it in January. We have a new update that should be completed by November 1st and will be released. This is a $9,500 report. We also have a separate report on projections for the next 10 years for iridium and ruthenium that we will produce and sell for clients. Now, going back to those odds and ends, GDP, we'll see a new projection, an early projection for the third quarter next Thursday. We have been in a shallow recession by definition of 2 quarters of contractions in the first half of this year. A bigger recession is coming, but the questions are, when will it arrive? How deep will it be, and how long it'll be? No one really knows, but the consensus projections are that it may arrive anywhere from this quarter, the fourth quarter of this year, or sometime in 2023, or 2024, 2025. CPM Group has been saying we projected it, have been projecting a recession for 2024, 2025. The IMF has come out with its revised projections for this year, 2022, full year 2022 and 2023. We will be incorporating that in updating our 10-year economic outlook to see if we shift our recession arrival date into 2023 from 2024. Right now, we're leaning against that, but let us do the work. That's why we're going to be talking about it. The other thing to note is recessions come and recessions end. You see a lot of the snake oil salesmen, for want of a better word, gold and silver promoters, waving their arms in the air, talking about a recession is coming and the stock market's going to fall 95%. And yes, a recession is coming. Recessions don't end. I mean, the occurrence of recessions don't end. Anybody who says, well, as they did it in a new economic paradigm in the late 1990s, we won't have another recession. No, recessions occur in the economy and on a global basis, and it's something that can't really be helped. What can be helped is trying to make the recessions as short and shallow and painless as possible. And you can see, just graphically, going back to 1947 here, from 1947 to 1982, we had a lot of recessions, and they were kind of bad. They were steeper. 1991, 2001, we had short, shallow recessions. We had the big one in 2007 to 2009, the biggest one since 1947. And then we had a real big one in 2000, engineered by the world's governments in response to the pandemic. And the economic lockdown, followed by the recovery. Talk about that more in the future. Another one, we had done some videos earlier in the year, in February and March, where we showed various hedges that investors could do. And we talked about how an investor could stay long physical gold or other gold assets, but if they saw the price spike higher, they could put in place a hedge so that if the price then fell back, they could unwind that hedge and take some capital and some profits out of, they'd be capitalizing their gains on the spike while remaining long. This was a hedge we did on February 1st when the price was $1,800, and we said an investor could lock in $1,650 floor through September of this year. And the price did, in fact, come down, and the investor who had done that could have sold that put and taken out a fair bit of money and profiting from the lower prices while keeping their long position. This was on February 1st. On February 28th, the gold price had risen even more sharply, and we put together a hedge with a $1,950 or a $1,975 floor. Somebody who had done something like that today could take out a couple $100 in profits from their hedge while staying long the physical gold or other gold assets that they have. That's what an intelligent hedge investor does. And the third thing is, I keep hearing now more and more about the gold moving from the west to east. And yes, we've seen gold and silver inventories decline, reported. It's very important to understand, reported gold and silver inventories in the New York market and in London decline. And there's all kinds of speculation as to where it's going. And again, the snake oil space, well, Westerners aren't buying gold, but they in the East they are. This chart shows you the gross imports, gross exports, and net imports into Switzerland. And you can see that net imports actually did fall into negative territory, or it did fall sharply in 2013. But you can also see that net imports of gold into Switzerland remain pretty constant, pretty stable. And over this period of time, 373 million ounces of gold have been added to investor holdings in Switzerland. Net imports between 2008 and September of this year have been 373 million ounces. So gold may be declining in other markets, but a lot of gold's going into Switzerland. In fact, you can compare that to 136 million ounces that were added to Chinese investment holdings stored in China in the period 2008 to 2022. So, not quite 3 times as much gold has been bought and stored in Switzerland as has been bought and stored in China. And of course, some of that stuff in Switzerland may well be owned by Chinese investors. And another 122 million ounces have gone into stocks, gold stocks in India over that period of time. So, yes, Indians and Chinese people and other Asians are buying a lot of gold, and they have been buying a lot of gold since 2008. But people who store their gold in Switzerland haven't been laggards. And more gold has been stored in Switzerland during the last 14 years than has been stored in China and India combined. Talk more about that in the future, but watch where you're getting your information. Thank you. That's all I have for now. It's been a longer conversation than recent ones. I apologize, but a lot of ground to cover, a lot of things to say. Have a good weekend. Take care of yourselves. Take care of other people, those around you, and all around the world.